Hi everyone, it's your daily 10-minute business and finance news wrap for this Monday, the 9th of May 2022. Later, we preview this week's US inflation data, which could be another big one, expectations of an annual rate above 8% possibly. But first, to the Australian banks, which according to PWC posted a combined cash profit for the half year of $14.4 billion. That's up 11%, but competition is tight. And what now for the industry? That interest rates are rising. For more, I spoke earlier with PwC's Sam Garland. Sam, firstly, how would you describe the way banks performed in the half year? So just how healthy are they and why?
Yeah, so for the first half of FY22, I'd characterise it as a strong, if a little bit uneven result, but also the cleanest result we've seen for a long time. And by clean, I mean a real lack of any large notables, which have been a feature of the result in the past. That's down to remediation, restructuring and the like, which really this half were non-existent. Prior half, 1.8 billion since 2018, $13.6 billion.
Can you run through more of the key themes, especially with the way they handled the pandemic?
Sure. So look, there's really three key themes in the result for the half. The first is that topic of notables. So over the last 5 years, there's been about $13.5 billion of charges for remediation, restructuring, fixing the business and simplifying it. There was basically none of that in this half. So that had a big tailwind into the half. The second is credit. So for the half, there was a $0.2 billion write back of credit expenses, which really reflects a kind of the final, I would say, immediate adjustments post-COVID. So the credit outlook has not been as bad as we thought it might have been, and performance has actually improved during the half, and that allowed some kind of write back within that. A typical half would be $1.5 to $1.8 billion of credit expense, and this half was $0.2 billion of benefit. The third item is balance sheet growth and margins. That's a very nuanced picture between banks, as you'd understand. But overall, a 6.7% growth in lending assets across mortgages and business bank, but a 9 basis point reduction in margins to 1.75% across all of the four. That represents the lowest margin that we can certainly find on records, and clearly brings into sharp focus the rising rate environment and the outlook.
Yeah, can we go into that in more detail? So we're now both in a rising inflationary environment, a rising interest rate environment. What does this now mean for the banks and the challenges and I guess opportunities going forward?
Yeah, sure. So if there's a few things to say of that. I mean, the first is that the banks are not immune to inflation themselves. And so a big focus of the commentary has been on the cost bases and the trends on that. Costs were down a touch for the half, but every bank talked about the pressure they're feeling around workforce, attracting talent and inflationary pressures. So costs is going to be a really big focus for the banks as they move out of this half, particularly because of inflation. I think with rising rates, look, it's a funny thing to say it, but for many of us, certainly me, I've never lived through an environment of inflation and rising rates, and many customers and even bankers haven't either. So it's in some ways kind of uncharted territory in recent memory. For the banks, they've been cautious to manage expectations around the impact on margins of rising rates. The reason for that is generally it comes through a bit slowly, but also it is fiercely competitive, particularly in mortgages, where the majors actually were outgrown by 3 of the non-majors during the half. And then the final thing to say is with rising rates, property prices, customer repayment ability, banks are pretty relaxed about that right now. They've all called out the stress testing that they've done to analyse the risk of that. And look, they're probably more concerned about potential unemployment rather than asset prices in the short term.
So in other words, just because rates are rising, it's not necessarily a really good thing for the banks right now because it's going to take some time to flow through and there's so much competition out there. Is that right?
That's right. I think, you can reasonably expect that in a rising rate environment, it's good for bank margins. I just think it will be a bit slower, and the banks have been careful to manage expectations on that, just given the extent of competition.
And just finally, a lot of attention over the past few years about the greener world, the world of decarbonisation. How will the banks navigate this? And is it something that stakeholders are really demanding?
Yeah, sure. So look, I personally, and we see this as a huge opportunity for the banks, but it's moving very, very fast, and it's coming firmly into view. So on the topic of stakeholders, I mean, if you look at the investor community and what they're asking of these listed entities, there's not really one that isn't having a firm focus on ESG and particularly climate credentials of the banks and the steps that they're taking, both to manage their own footprint, their direct footprint, but also to help their customers transition. I think it's a huge growth opportunity. We're going to see a massive rebalancing or reorientation of the Australian economy over the next 5 to 10 years because of net zero commitments. Banks provide finance, banks provide guidance to their customers through big changes. There's none bigger than this, in my view. And so for the banks, I think this is a massive opportunity, but they've got to get ready for it.
Sam Garland there from PWC, and the Australian share market fell today. The S&P ASX 200, 7,120. That's down 1.2%. Westpac was a standout, going up though about 3%. For more, I spoke earlier with George Boubouras from K2 Asset Management, and also to take a closer look at what the environment now means for banks and for bank investors.
A number of things, Ricardo. A lot of headwinds from global markets. Following the month of April, it's continuing into May. Higher rate environment from the US Federal Reserve, the UK, Australia now joining that as well to deal with inflation and a number of other issues with quantitative tightening. And there's this desynchronization of growth going on, where Europe is approaching recessionary scenarios, where the rest of the world have got reasonable growth rates. So a number of concerns for financial markets to try and build expectations going forward so they can start pricing in what's the correct valuation. And that will persist throughout the month of May.
Would it be fair to say that the US inflation numbers out later this week will be one of the key things to watch? Just how will it feed through to markets, do you think?
Without a doubt. So we're looking, and obviously the biggest economy in the world, the Federal Reserve's looking at it. They're having an aggressive rate hike cycle, but this inflation number this week is quite critical. They really need anything with a 7 handle means inflation is increasing at a decreasing rate. We are all looking for it to roll over. That's what the higher rate environment is at the moment. That's what we're trying to price in. But the market is looking for that guidance. But the US economy is quite robust and strong. And that higher rate aggressive cycle coming is to slow that down and to address, again, this higher inflation problem that's been with us for nearly a year.
Westpac, $3.1 billion interim cash profit today, wrapping up the bank reporting season of the half year. What do you make of it?
Yeah, so Westpac, is the $3.1 billion, that's ahead of expectation. What they've done very well is the cost cutting. They're ahead of schedule on their cost cutting. Their ratios aren't as compelling as the other banks, but this is a good result for Westpac. They've really been dealing with a lot of things, particularly coming out of BT Financial Group, that cost them a little bit of money, that funds management and fund-to-fund business. And they've got that multi-brand as well, so Bank of Melbourne, Bank SA, St George Bank. So they've got a lot to offer out there, but it's a higher cost structure. But this result was ahead of expectation. The stock is up on the day, and it's a good result. And more broadly, financial services and diversified financial, but particularly the banks, benefit in raising on a high interest rate environment. Just like US banks are benefiting from a higher rate environment, the Australian banks would also benefit. Their margins will improve, or an opportunity to improve. Their net interest margins is what we look for, and so higher mortgage rates, a better margin environment for the banks going forward. But again, Westpac, great result today. NAB is the standing highlight, the best of the big four with their results, and they're progressing very well.
So now that we've heard of the big four, like you mentioned, are there opportunities in the sector?
There are opportunities for the sector. Again, NAB is the one that's been doing it very well. Their margins are good, and they're a good business bank as well. CBA are the larger one, and they seem to do reasonably well. That's the standard. Again, Westpac, the surprise. ANZ is trailing, trying to catch up. But we take a step back, and our big preference is the investment bank, Macquarie Bank, that's effectively a global investment bank that is positioned very well for global earnings growth with high US rates as well.
Finally, so in this rising interest rate environment, are there any areas of interest in the market for you? And how are you playing it?
Yeah, so the way we as active fund managers play it is we like financials and diversified financials that benefit from rising rate environment. We also like commodities right across the board. That's bulk commodities and metals and energy, and they're also going to be the beneficiaries of ESG investing as well. But they tend to do well and aggregate those earnings before a rate hike and at the early stages of rate hike cycle. So the commodity area is a big overweight that we have, and that cushions the Australian economy as well as the Canadian economy, parts of Indonesia, for example, and South Africa. So commodity economies are going to be the beneficiaries going forward of that powerful tailwind coming through, the demand for commodities, the investment in commodities. And again, the ESG transition requires the commodity sector.
George Boubouras there from K2 Asset Management. This SBS on the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.